okay? When your longer term charts agree with a shorter term chart, okay, you're likely to go ahead and have more. So when the mutual funds, when the hedge funds and all that are selling and going in the direction of the longer term trend and your 1 minute trend, okay, this is the Dow Jones Industrial Average 1 minute chart, you're likely to have more significant moves, sharper in nature, and what does that mean for you? Far more profitable. So I would encourage you as much as possible. I'm not saying don't take long side trades in the current environment because the monthly chart and the weekly chart is not going your way. I am saying though, you give more credibility, and hence you hear my comments now on the daily bias in my YouTube videos. My bias is always looking for sell side trades. They're the preferable trade. They're the trade of choice because they're the trade that's likely to make the most amount of money the fastest, because as the overall trend is down and hedge funds are selling and mutual funds are selling and individuals are selling, you're likely to get the sharpest move the fastest, okay? So that's how I use the longer time trades. And if I'm in a counter trend trade, so I'm in a short-term long position against the daily, weekly, monthly charts, I'm going to trade either less size, and I'm going to go ahead and stay in that trade a lot shorter amount of time. I'm not going to sit here and say, gosh, I've been in this trade for half an hour. I hope this trade starts working pretty soon. Those of you who recall from yesterday, I actually like to see my trades work within about 15 minutes. So, you know, I want to go ahead and just emphasize it's going to affect the longer term time frames will affect my trading on an intraday basis, and I would encourage a 1 minute or 5 minute trader to give the same deference to those long-term charts, because when you're trading with the trend or you're adjusting your style to accommodate the longer term time frames, I think that's more of a recipe for success versus constantly fighting the trend. There are some people that always want to go long in a bear market, and they always want to go short in a bull market. And it takes a lot of discipline to be that successful to do that consistently for the long term. But it's a lot easier to go ahead and trade with the trend. Okay? So, Todd, with that being said, I think is there any other questions that came up in this
No,
section?
no other questions. So if you wanted to move to your ADX discussion, and then if we have time, we could always. I have a few questions from yesterday that weren't answered. We can always come back to those if we need to.
Okay, no, that's fine. Well, then what I'd like to do is, if you don't mind real quick, I'm going to reset my chart back to how I had it. And then I'd like to go ahead and open up a discussion on the ADX. Now, for those of you who know, I have an ADX right on my master screen here. It's very important. It's a tool that I use as part of my trading, but I'm actually going to go ahead and I don't have a price action attached to it on my front trading screen, because you recall from my previous webinar, the one that's on my front trading screen, I actually only have regular trading hours on, okay? However, the other charts I have on my screen here are 24-hour charts, so I couldn't have them on the same screen, so I have it kind of set independently of the other charts. So what I'll do is I'll go ahead and open up one of my other charts for you, which is, we'll use the, use the hourly Bollinger Band one here. And then I'll just move this to a 15-minute chart. Okay. And this is I just want you to know, this is a 24-hour chart. Actually, I want to change that though. No, it doesn't matter because the concept will be the same. What I want to go ahead and show you about the ADX is a couple of different things, okay? And take note of this, because I feel that the ADX is a great trading tool for people, and the ADX, like so many other indicators, gets used different ways, and in my opinion, many of the ways are not the best ways. So one of the things that I want to go ahead and point out is one of the rules for the ADX is usually that the ADX has to go ahead and come from below the 20 level. You see these are the levels over here. And so 20, 30, 40. The ADX has to come from below the 20 level and rise back up and then get above. I've seen multiple different numbers. I've seen 20, 25, 30, and 25 and 30 seem to be the most prevalent numbers I've seen. Okay, and so what happens is the comment that's being made is that let me get my arrow key on this now. So technically, a lot of systems profess don't take a trade unless you've gone ahead and come from below the 20 level and gone back above the 30 level. My first comment about that, and let's talk about what the ADX is for those of you that are new, since this is a beginning class. The ADX as a whole, Welles Weiler went ahead and created this, as I recall. Great, it's a great concept. It's a great tool. I love it. I've actually modified this and used different ways. In fact, here you see I use a 13 by 8. I've got different variations of this that I discussed in my indicators webinar. But what happens in summary at a high level is when this is rising, okay, the ADX itself, this is the ADX, and then these lines down here, the blue ones, the positive DMI and the negative DMI. Okay, so this is the ADX, DMI, and DMI, positive and negative. When the ADX is rising, it's indicating to you that the trend in place is a stronger trend, okay? Doesn't reflect whether the price is going up or the price is going down. What it reflects is that the trend in place is strong. So what you'll see here is when you see this rising, okay, regardless of whether it's coming from below the 20 or not, it's a stronger trend, okay? And that's the first thing I want you to note with that. Disregard whether it's come from below the 20 level or not. Because here you'll see the trend kicked off. In fact, here, ironically, remember we were talking about wide range bars? Well, this is yesterday's trade. Let me go ahead and expand this chart. Okay. This is yesterday's trade. So here's these wide range bars we were talking about and how they kicked off a move. If we were to put a 20-period moving average on there, I'm sure we'd see if this crossed above the 20-period moving average. What happened is, so we had these wide range bars. Well, so this was starting to kick off a new move that was a strong move, okay? And what was happening was the ADX started rising. As we pulled back, the ADX went ahead and fell, but you notice it only fell to the 25 level. So if you follow these systems, it says the ADX has to come from below the 25 or the 20 level to take the trade. You completely missed an opportunity in here and here on this, okay? So what I'm looking for with the ADX, in fact, let me tell you right now, the strongest, I don't think I gave this in my indicator webinar either, so another tidbit for you guys. When the ADX rises and starts to pull back shallowly, as it did here, and then starts to rise again, that is a really good trade generally, because it's just it's kind of demonstrating a pullback within a trend. When in the ADX, when it's rising, of course, is showing strong trends. So for you to see us go ahead and make a higher high than it did here and break out, what you're looking to do then is buy pullbacks to like the rising 20-period moving average or my speed lines, which I've shown you on other charts. So keep that in mind, especially as like a scaling strategy and such. So first thing is I'm looking for the ADX rising. And when we talk about that confluence of indicators, I really like that ADX rising whenever possible. Okay, if I'm taking a with the trend trade, I'd like to have that ADX rising. So if I'm looking to get into a position, hold it for more points, let the thing run, that's the kind of trade you really want the thing to be rising for, okay? If I'm looking for a scalp, then I may not be so concerned that the indicator is falling. And speaking of which, I did see one of the questions that was asked yesterday, I believe, that did not get answered. It was asked again this morning. I believe it was from Oriel. I hope I'm saying your name right. I want to answer that right now just so the question doesn't get missed. What is a scalp to me? A scalp to me is a person that's trading for generally one tick to roughly 4 ticks is generally a scalp. Okay, if you're trading for more than a full point, it's generally not so much of a scalp. but the 1 to 4 tick, 1 minute to 5 minute type traders who are trading in and out, which is why they're trading on the short-term time frames like that, that's more of a scalp to me, okay? Hope that answers your question. I don't think going for 2 points in the market is really a scalp, because 2 points can take time. Now, in the recent price activity of the last couple of months, 2 points, you're seeing 5, 10, 15 point moves in a matter of 15 minutes or so. So but going back to normal market conditions, going for 2 to 5 points can take a couple of hours in normal market conditions. Okay, so I don't think that's so much of a scalp. I think somebody who's trading in and out for 1 to 4 ticks, that's more of a scalp. Okay, so I hope I answered that question. Now, going back to the ADX, if I'm looking for a scalp, if I'm looking for the short-term trade, I don't mind if this happens to be going down. If I'm looking for 6 ticks to 2 points or more, I'd really prefer this ADX to be traveling with me, showing me that, okay, I'm riding a trend that's strong. Okay, give me 1 second here. Sorry, I just had to clear my throat. So that's what a key concept. Don't get yourself concerned about, gosh, is this above the 30 level like these these people that develop these systems call for. In fact, I would remind you that in this case, if you waited till it got above 30, okay, you could have gone ahead and been profitable still. Let me go ahead and get this off the thing for a moment. Okay, so here's around your 30 level, it breaks, but you would have had to have suffered a pullback here, and so if you weren't scaling into this trade, you would have gotten stopped out before the trend resumed, okay? So by the time, and same thing here, this thing rallied up, gets up to the 30 area, and that's the very short-term top in the market. Same thing here. This thing was selling off here as a, it was rising from down these lower levels. So it was up here around the 96, 97 level in overnight trade, trades down to as low as the 90 area, so about 6 points of movement as it's rallying. But if you waited till it got to the 30 level, you actually were on the wrong side of that trade. If you shorted here, you end up getting stopped out again, back up 6 points. So the thing I try to do with my indicators is I make them work for me. I go ahead and I don't follow the traditional conventional analysis that people teach out there, because in many cases the conventional traditional analysis is wrong. Okay, in my opinion, it's wrong. And as you can see, just that system I was showing you here, if you waited above 30, here, if you waited above 30, it did go ahead and work. But how many times do you got to pay a price to be on the wrong side of the trade? 2 times it worked, 2 times it didn't work. So what are we at there, 50% ratio? I'm not trading anything that works 50% of the time that I know of. Okay? So, and I would encourage you to think along the same lines. So what I would say is be more focused on, is it trending up in the first place? Now, another thing I want you to focus on is these DMI lines, okay? If you're looking to go long the market, you want the positive DMI, okay, to be on top. If you're looking to go short the market, you want it to be on the bottom. Do not look at taking long side trades in this market. If this is my opinion, you can do what you want, obviously. If that's your risk trading plan, you do it. But you want to know how I do it? Here's what I'm telling you. If I see that the the positive DMI is below the negative DMI, I'm not looking to take long side trades here. Okay, so keep that in mind. All right, and you see how let's look at that as we go through the different trading sessions here, because and actually before we even do that, let me talk to you about some other things. The DMIs, when they're entangled in each other, is generally a chop area, and when I say entangled with each other, I'm talking around the 18 to 30 level. Okay, kind of just chopped into that area. I usually, for the best trades, like to see one of the DMIs to be below around the 18 level. Okay, and here you'll see just that right here. Okay, that one worked very well. Here, Well, it dropped. It did go ahead and drop below the green line is actually at the 15 level here that you're seeing across here. So actually it starts a little bit above that, just so you're aware. So right above that, right about here is where it started. Now, I can't see the thing, but you see this was where we had the 6 points down in overnight trade, mind you. 6 points in overnight trading. And then back here, regular trading session, you see how it was down below the 18 level again, and how that was this was the negative DMI was below, so the positive DMI was nicely above. There was a nice spread between these two. See, it wasn't congestion like here. It wasn't congestion right here. The spread, I'm looking for that spread to be taking place, and one of these indicators to be far, better off, which is below the 18 level than the other one. So the one that's below, I'm usually looking for the counter trend or the opposite side trade. So if the negative DMI is below 18, I'm looking for a long side trade. Okay, and let's go back. And like I said I wanted to discuss this a little more thoroughly today. Tom, I think this is really going to, be something you can, look at based on your question. So I'd like to just go ahead and show. I'm randomly selecting an area, okay? But I just want to go ahead and show this to you again. All right. So here was overnight trade, and look what happened. These were congested on each other. See that? Okay. So no trade. Here they go ahead and they start spreading, and you see we're starting to get below the 18 level, and it was the positive DMI that was below the 18 level. And so what do? We look at short side trades. And sure enough, we had a couple of nice short side trades that were in that as we were bouncing off of support levels. The other thing I'd like to point out, I don't want to get too far off track, but I do want to point out to you, I've shown you guys how my RSIs are very
muted. Unmuted.
I've shown you guys how my RSIs are very important to me. And I'm sorry, my thing went on mute for a second there. I hit the wrong button, so I just want to repeat that. And you'll notice here then too, we had my RSIs below the 50% level for this. So now I've got my DMI below the 18 level for the majority of this. And when we rally up, we only hit the 50% level and start to fall back down again. This is, I believe, this is a 20-period moving average from the Keltner channel, 20 or 21 period. Looks like 20 period. So, here you see this actually is going ahead and hitting the resistance on the downside, also 50% level, also tying in very well with my DMI indicator setup that I was looking for. So here you see this confluence of indicators going ahead and giving you a great sell signal, okay? So that's very important. Look for those things, Tom, and everybody that's listening today. Look for the, ADX and DMI situations. Look for strong trending. Let me clear this off and recap. Look for strong trending, ADX. Don't worry about if it's above the 30 or not, but look for it to be rising, okay? Look for the DMIs to go ahead and be spread apart, not congested. If you can combine this with the RSI being below the 50% level, there's even more confluence. And when you see a confirmation where it hits your falling 20-period moving average and starts to pull away again, great trading opportunity. Todd, was there a question?
No, not this time. I did have one question for you, just for clarification purposes. I know you like your ADX on the market-only data. How does it affect, like on this chart here, where you have overnight data?
Yeah, well, what happens is that you go ahead. You're right. On my primary trading screen, I like to look at the market data or regular trading hours data only. I like to also, but you see I have it on my, other charts as well. I have it on 24-hour charts. The thing is that what happens is, especially if you try and teach this to students, you'll see during an overnight trade, unless you have a very active overnight trading session, what's going to happen is your DMI, first of all, your trends, usually because the market in normal market conditions becomes much less trending, so your ADX is going to fall very low. Your DMIs are going to become little entangled snakes, okay? So not until you get into the regular trading hours again is it really going to go ahead and start to open up for you. So but nonetheless, if you are an overnight trader, where you're I know we have some people in, some of our colleagues here, that trade with us are actually have full-time day jobs where that only allow them to trade at night. And that's fine. And when I say night, as you guys know, my personal preference is usually after 2 a.m. Central Time going forward. Just so you guys understand, from around this whole time frame in here, from this whole 8 o'clock at night till 2 o'clock in the morning in particular, on a normal night, I normally don't see a whole lot happening. It's just dead. There's not a lot of volume. There's not a lot going on here. But after about 2 a.m. Central Time, things tend to get a little more interesting generally, and there's some trading opportunities. If you're an overnight trader, then that's trading during those time frames, you would want to go ahead and look for opportunities. And let's just see if we can pull up some overnight activity that actually had something going on. Here we had the time frame. Now this is my 2 o'clock Central Time here. Oops, sorry, the thing moved off. But so you'll go ahead and you'll see that as we get into the a little bit later, there really wasn't much happening here. These were entangled snakes, okay? But we did go ahead then, and around 6:37 a.m., which is still good for many people to be able to trade, we crossed above the 50% level. We went ahead and had the ADX start to turn around with a move to the upside, and then you actually see there was an opportunity here for, looks like roughly 5 points, if I'm looking at this correctly, of trading opportunity after the initial thrust, and then you had the consolidation. So being realistic about it, even if you captured any sort of that using the ADX, you're better off. And so I like to use the ADX because obviously I trade, generally speaking, regular trading hours, or personally, unless I happen to be awake for some reason, I'm usually trading after around 6 a.m. Okay. But I will look at this then. If I am trading in pre-hours, I have the chart for looking at the ADX for just that reason. Okay. So, but during regular trading hours, I like to use a regular trading hours ADX. That's just the difference, whether I'm trading overnight trading hours or not. Because if I'm not trading overnight trading hours, you get more latency or lack of motion, sluggishness, if you just let the ADX ride all night when you're not actually a trader in that time. And then you come into the next morning and it goes ahead, it takes a while then for your chart to catch up with itself. So I try to eliminate that lag by having the regular trading hours only ADX on the regular trading hours screen. Todd, hope that answered your question.
No, that was great. I just figured that would be a good clarification since you used both of them.
Sure.
Tom does have a little follow-up for the ADX. He asks, does the ADX always need to be at the base or below 20 and trend upwards to be a strong trend? It appears that strong trends where ADX is extended then corrects downward, but still seems to be a nice trend.
Okay, you know what? Do me a favor. I was with you on most of that, but if you go ahead and I think the question was, does it have to come from below 20 to be considered a strong trend? Is that basically?
That's kind of what I'm getting. I'll read that first line there for you. Does the ADX always need to be at the base or below 20 and trend upwards to be a strong trend?
No, and that's what I was saying actually, Tom. That's actually the conventional wisdom. But from my perspective, no, it does not. In fact, I would submit to you right here, let's just go look at a live example that we can see right here. This ADX was at about the 23 level. Okay, you see how it fell here? It only hit the 23 level and then started to go up. Well, you would have missed one heck of a move up if you were waiting for it to go below 20 first to actually go ahead and make it a strong trade. So absolutely not. That's some of that conventional wisdom I was trying to dispel for you. Does not necessarily have to be. And the same thing was with here. You see that this trend down here did originally start below 20, but then when it pulled back and started off again, you would have missed a whole lot of opportunity up this way if you didn't wait for the pullback to come down and back up like the trend, the conventional wisdom. So especially, here's a great example of it. Do not go ahead and fall into that conventional wisdom. Let's understand where conventional wisdom comes from sometimes, okay? One of the books that I recommend on my website is the Edwards and McGee Technical Analysis of Stock Trends. That book's been around since the early 1900s. What does that book talk about? All sorts of great patterns you guys all know and many of you love. Double tops, triple tops, congestion zones, et cetera, et cetera. That information has been out for 80, 90 years now. The thing is, what happens is, I don't know how else to say it. Somebody always wants to go ahead and reinvent the wheel for profit. And so, I mean, my gosh, just think, guys, how many of the things that I show here today that I could turn around and repackage because I used it a different way and sell them as custom proprietary indicators and everything else. I could make a killing on that stuff. But the thing is, I think that sometimes people take a conventional tool, a good tool, and then they want to put these twists and tweaks. I've seen the 20 level I told you about. I've seen the 25 level. I've seen, it's got to cross above 30. They take the same tool and then they just say it's got to be this instead of this, and go have a bunch of $5,000, $10,000 seminars or webinars, and make a killing off this on people. And those are the kind of people that I call gurus. And it just, anyways, that's frustrating. We're on a webinar. I'll get off the topic, but to just understand, Tom, there's this conventional wisdom out there. I'm trying to show you kind of a difference to the conventional wisdom or the tweaked wisdom, shall we say, along the way that people have made along the way with these great indicators, and then said, no, you got to have this rule in there, you got to have this rule in there, and trying to dispel some of that, move some of that stuff away so you have more trading opportunities and more things to look at. And so in closing on that, no, you do not have to go ahead and have this fall below the 20 and start to rise above the 20 to be a good trade, as we see right here with this live example. Todd?
Tom, if you could do me a favor and maybe clarify this new question you have about the ADX and something about a yellow market, the 12 to 12 or 12 to 2300 hours, because it was kind of choppy. I couldn't understand what you were asking. And real quick, Joe has a question. He wants to know, what are the yellow bands used for on the RSI? I think those are just channel lines, if I'm not mistaken.
Yeah, let me just expand this for you real quick, Joe. All these are is a different level. Let me get this in here. It's just the 55 and the 45 level. The reason why I have those in there is I found a lot of times, Joe, you'll recall from some of my other webinars, we've talked about fish hooks. Sometimes I've seen some really good fish hooks take place within those channels. And so I've identified those as an area where I like to go ahead and pay attention to fish hooks taking place or bent fingers within those zones that are close. Because what happens is, especially when a market has come through or a level, like if it's gone ahead and come down through the 50 and then it has a fish hook, or it comes back above the 50 and has a fish hook, and then it happens shortly after breaking that 50 level, it's usually, it can signal a great trade where what's happened is the market has changed direction, and what's happening is you're getting a thrust back through to the new, above 50, but it only has enough energy to get slightly above 50, has a pullback and kind of creates then the broken arrow, the fish hook, and then goes ahead and launches off. So I just like to look out for bent fingers and fish hooks in that area. So, and also it's just another warning area to me that says, hey, we're getting close to the 50% level, which I've shared with you guys in the previous webinars that, it's an important level to me. I mean, just look at this chart alone. Let me clear my chicken scratches here. And take a look, what happens when we get back above, sorry, I hate when I do that. When we get back above the 50% level here, first of all, we're below the 50% and we stay below it, we keep getting sell-side trades. We finally break above the 50% level, and look what happens. We start going long. We pull back to the 50%, and which happens to be a rising 20-period moving average, and then there we are off to the races again as it separates itself from the 50, okay? I've tried to share with you guys great tools that I think would really benefit you, and try to focus on those. And I hope that you're seeing that. So, Joe, that's kind of what those extra trading bands are. They're alert areas for me where something could be happening with either a hook or a buy or sell opportunity.